Welcome to the Daily Update Podcast, where I'll go over the action in the market for Thursday, December 11th, and we'll see how things look for Friday, December 12th. Stocks closed mixed, but the S&P 500 etched another all-time high, closing at the 6,900 level, up 0.21%. The Dow, Russell 2000 small caps, Wilshire 5000, and the total U.S. stock ETF all joined the party with fresh record closing highs. Small and mid caps continue to show impressive relative strength. On the flip side, the NASDAQ and NASDAQ-100 finished modestly lower as mega cap, tech, and growth stocks underperformed once again. Oracle's post-earnings reaction was particularly harsh, and Broadcom has dropped about 4.5% after the close, despite beating earnings estimates. This could have an impact on Friday's open. Value decisively outperformed growth for yet another session. This remains one of the clearest rotating themes of the past several months. During the day, the S&P had a choppy ride, especially after the open. The S&P did open lower, briefly dipped below the key S1 pivot near 68.41, but buy the dippers stepped in during the afternoon as well as the smart money and engineered a steady recovery that pushed the S&P back above the 6,900 level by the close. Volume was below average, which is a mild negative divergence, though we must remember off-exchange volume is not published. The Fed's recent rate cut is still in the rearview mirror and being taken as positive. The markets are currently pricing in 2 additional cuts for 2026, while the latest Fed dot plot is showing only 1. The soft landing narrative remains firmly intact, meaning no recession, supported by a solid economy. The 10-year Treasury yield slipped to 4.14% and the dollar was weaker, both tailwinds for stocks. Geopolitical risks and the ongoing AI spending boom remain background concerns, but they're not disrupting price action in any meaningful way, at least yet. Going over the key positives, all 3 major time frames, the short, intermediate, and long term, remain in uptrends. Sentiment has improved and is back to neutral at 46. The advanced decline line, based on price and volume, hit a new all-time high for the S&P. All 3 smart money indicators are positive. Breadth, momentum, the McClellan oscillator and summation index, as well as the TTM squeeze, are either positive or improving. Small and mid-cap indexes continue to improve as well. And perhaps the most encouraging for broader participation, the value line geometric index finally broke its multi-year downtrend line that has been in place since the peak in 2021. Now we'll see if it can stay there and add to those gains. On the negative side, there are some lingering yellow flags. Growth continues to significantly underperform value. The large cap growth to value ratio is weakening and flirting with a potential death cross. Mega cap and tech leadership is conspicuously absent. The NASDAQ 100 still has positive momentum, but price action remains soft. There still is a confirmed Hindenburg omen that remains active until December 26, unless a new confirmation spike appears. Margin debt is rising again toward prior highs. The S&P 500 forward PE ratio remains elevated at 23. The economic data releases were light but constructive. Initial jobless claims did rebound to 236,000, a more normal figure after last week's anomalous 192,000. Continuing claims did drop back into the 1.8 million range. This is positive. The trade deficit came in much better than feared, at a minus $52.8 billion versus a minus $61.7 billion that was expected. Wholesale inventories unexpectedly rose 0.5%. Looking ahead to Friday, December 12th, Friday's a quiet day with no economic reports scheduled to be released. Seasonally, the first half of December tends to be okay, while strength historically develops in the second half of the month. Looking at December 12th, going back to 2002, seasonality is relatively flat, no strong historical edge either way. The near-term bias remains mixed to positive, but leans cautious until we see meaningful participation from growth and mega-cap names. In conclusion, the S&P 500 continues to grind higher, powered by value, cyclicals, small and even mid-caps. Conviction is moderate at best without the former leaders on board. The S&P remains expensive, but there are no clear sell signals in sight, at least yet. The trend and momentum remain unequivocally up. The Hindenburg-Ullman clock is ticking, but virtually everything else says uptrend intact. Thank you very much, and I will talk to you in the next podcast.